Hi, good morning, everyone. Welcome to our research morning call. Today we have some fully on the ground updates from MLT, Lippo Malls Trust, and MCT and Mapletree Commercial Trust. This will be followed by a result update from KDC REIT, a snapshot on Nanofilm Tech's IPO, and we also have the model bond portfolio review and the US election sector update. We will then end off with Phillip on the ground for KREIT and SG Weekly. So without further ado, I'll move on to MLT. Okay, so first up, we have some brief second quarter and acquisition updates from MLT. This is our Phillip on the ground. We have no coverage on this counter. For this quarter, their portfolio remained resilient. Their distributable income and DPU grew by 6% and 1.5%, supported by higher income from existing properties, accretive acquisitions, and contribution from the recent Old Law Phase 2 redevelopment. Portfolio occupancy remains high at 97.5%, and they registered positive rental reversions from new and existing leases this quarter. Next, please. In the same call, MLT announced an acquisition of 9 properties in China, Malaysia, and Vietnam, as well as the remaining 50% interest in 15 properties in China. This 1 billion investment will be funded by equity and debt, as shown in the graph on the right. The fundraising will be done via a private placement and a preferential offering. Next, please. From the top 2 charts, you can see that close to 85% of the new acquisitions are Chinese properties. The remaining 2 properties are from Malaysia and Vietnam. MLT views these markets to be fast-growing, underpinned by robust consumption growth and increasing urbanization to provide these markets with further upside. Post-acquisition, the 10 billion portfolio will now be more diversified, with a 71% exposure to developed markets. This acquisition also introduces greater tenant diversification as well. If you look at the bottom left chart, JD.com and Cainiao are the biggest 2 tenants in the new acquisition. So now within the enlarged portfolio, they become part of the new top 10 by gross rental income. Last but not least, post-acquisition, MLT is expecting a 1.3% DPU accretion in terms of pro forma numbers and a 2.4% reduction in leverage. In terms of NAV per unit, MLT is expected to see a 6.6% accretion. Furthermore, just shortly a few days after that announcement, MLT actually followed up with another 114 million property acquisition in Australia. This acquisition is expected to be accretive, with an initial NPI yield of 4.9% and is expected to be debt funded. Upon completion, MLT's leverage ratio is projected to be approximately 37.4%. MLT is probably looking at another smaller acquisition, as they mentioned that they are looking at an acquisition size of 200 to 400 million within the next 6 months. Next, please. Okay, so next up, we have some acquisition updates from Lippo Malls via our recent webinar. It's also part of our Phillip on the ground series. We don't have any coverage on this counter. Lippo Malls is acquiring a retail mall that is supposedly the largest mixed-use shopping mall in West Jakarta. And as of 2019, the property serves 17 million visitors a year. Some highlights of this acquisition: the property is to be purchased at an average of 9.5% below independent valuations due to COVID-19. Secondly, the property is yielding 9.7% with income support that is provided by the vendor. The vendor is a wholly owned subsidiary of the sponsor. It is providing an NPI guarantee of 340 billion rupiahs per annum for the next 4 years. So you may think of this as an income support, as in you can think of this income support as a top-up function to help the property tide through this COVID-19 uncertainties. Next, please. The total acquisition cost is expected to be approximately 392 million, which will be funded by debt and equity. 1/3 of the cost is expected to be funded by debt and vendor financing, where the vendor will provide up to 40 million. 1/3 of the cost is the remaining will be via a rights issue of almost 4,700 units at 6 cents to raise 280 million. As a third pillar of support, the sponsor will take up its full pro rata stake in the rights issue and apply for all the excess rights not taken up by the unit holders. So lastly, just some impacts of the acquisition and the rights issue. The theoretical ex-rights price based on current share price is 7 cents. Post-rights issue, the market cap is to increase by 83.5% and leverage is to fall by 1.5%. But in terms of DPU, we are expecting a dilution of 56 to 62% based on FY19 pro forma numbers. Next, please. Okay, so this is our last Phillip on the ground update from me. Again, we don't have any coverage on the counter. In terms of their one half results, their gross revenue and MPI was down marginally due to COVID-19 impact and rent rebates. This is offset by the contribution from MPC2. But in terms of DPU, there was a larger decline due to capital allowance claims and retained capital distribution. For MCT, the portfolio occupancy remains high at 97.7%. MBC becomes the anchor asset in the portfolio. Valuation-wise, we saw a 2.3% dip in the portfolio. The devaluation is more prominent in the assets with retail components like VivoCity and the PIC building, which saw a 3.5 to 4% dip. Next, please. Shopper traffic and tenant sales in VivoCity are still quite down substantially if you see like the year-on-year, half-year numbers in the chart on the left. According to the management, the recovery is not as fast as the suburban malls or even the CBD malls because Vivo is actually getting hit on two fronts. First of all, with remote working becoming more prevalent, the lunch crowd from the CBD actually reduced quite significantly. Then secondly, VivoCity is also a tourist attraction, and tourists actually contribute 1/4 of the footfall historically. Therefore, the closed borders actually impacted the footfall. On the bright side, people are actually spending more when they're visiting. So even though there's a fall in shopper traffic, the tenant sales actually rebounded more sharply. Moving forward, MCT did mention that the outlook in both retail and commercial may remain weak. In terms of rent negotiation for retail, negative reversions are expected, and the management is hoping to keep the reversions within negative 10%. They do think that they will need to continue with the rental support, but that is conditional and only for struggling tenants that is still seeing negative sales of more than 20%. In terms of office, the management thinks that the work from home phenomenon will go in tandem with the closed borders for the next 2 years. The impact to office will be more delayed as compared to retail, but by next year, MCT thinks that companies will be more certain of their space needs, and that will be when the impact will be more visible. That's all from me now, but now I'll pass my time on to Ned, who'll talk to you more about KDC.
Hi, good morning, everyone. So I'll be talking about KDC's 3Q update. So jumping right in, gross revenue was up by about 41% in the third quarter, and DPU was up by 22.1% year-on-year for the third quarter. This was largely driven by acquisitions. So the acquisitions that contributed to this jump in DPU were KDC4 in Singapore, acquired on the 31st of October 2019, and DC1 acquired 21st November 2019. Also, Kelsterbach, which was acquired earlier this year on the 1st of May. So the 9 months DPU formed 71.3% of our FY20 DPU estimates. So it's on track and in line. So this quarter we experienced, KDC experienced relatively strong leasing. Occupancy inched up from 96.1% to 96.7%. This was largely driven by KDC Dublin 1, the AEI to bring on more power for the asset, and post this AEI, there was an occupancy uplift from 63.3% to 81.1%. So there were also other leasings, such as at KDC1 and KDC2. There was an expansion by a telco tenant, and the lease was kicked in on the 1st of October. Additionally, there was also an early renewal for one of the Australian assets called iSeek Data Center, and this termed out iSeek's WALE from 6 years to 10.7 years. So on the negative side, KDC experienced some construction delays in their AEI and development timelines due to the COVID-19 situation, which actually pushed back delayed some of their construction. Presently, they are still facing some intermittent disruptions due to delay in certain supplies as well as manpower scheduling. For KDC's outlook, KDC is in the advanced stages of negotiating several third-party deals, and they have shared that these deals are with cap rates between 4 to 7%. Yeah, so what's holding back the completion of these deals is the travel restrictions, which prevents KDC's team from actually citing the assets before acquisition. So while demand for data centers has compressed cap rates and driven up prices, KDC shared that the asking prices for the deals under negotiation remains unchanged. There's also a demand-supply gap in the market due to the heightened competition chasing the assets, as well as moratoriums that are largely still in place in many countries. So this is what is resulting in the demand-supply gap. And even though KDC's portfolio occupancy is relatively high at 69.7%, and they have a long WALE of 7.2 years, this means that there's very little expiries coming up. So there might not be chances to actually charge up higher rents due to the bidding up of these rents. The silver lining is that KDC's leases, majority of them actually do have built-in periodic rental escalations, averaging 2 to 4% per annum. Okay, so we reiterate our neutral call and raise our TP from $2.57 to $2.91. This higher TP is driven by our inclusion, or rather our estimation of about 500 million worth of acquisitions in the first quarter of 2021. So we're estimating that these acquisitions will have a MPI yield of 6% and done with the LTV of 30%. So even with this $500 million worth of acquisitions, our TP is still $2.91, which is below the current target market price. So what will push our TP to $3 is an assumption of almost $1 billion worth of acquisitions. Yeah. So presently we are only assuming a more conservative 500 million, which is in line with basically the acquisition of KDC4. Overall, our call on neutral is because we believe that the potential catalyst from acquisition as well as STI inclusion has been priced in. Yeah. So that's all for me. I'll pass the time on to Vivian.
Hello everyone, I'll be doing a brief introduction about the IPO by Nanofilm Technologies International, also known as NTI. There were no meetings with the company, so this presentation is entirely based on the IPO prospectus. The company launched its final prospectus last Friday at an offering price of $2.59. I'll be going into the IPO statistics later on. So firstly, a brief background about the company. It was founded in 1999 by Dr. Shi Xu, who was previously an associate professor at NTU, and the company was founded as a high-tech spin-off from the university. They specialize in advanced coating for hardness and also materials that are scratch and corrosion resistant, etc. The key product is Tech-On, which is one of the hardest materials in the world, and it is deposited as a thin film. They serve over 300 customers, including Fortune 500 companies like Fuji, Xerox, Canon, Nikon, Microsoft, Huawei, and their largest customer accounted for 56% of their sales revenue for the financial year of 2019. The company has three main business segments, namely advanced materials, nano fabrication, and industrial equipment business units, in short BU. And for the first half of financial year 2020, the segments that recorded the highest revenue included computer, wearables and accessories, and smartphone from advanced materials BU, and also industrial equipment BU as a whole. NTI has a resilient and scalable business model with sustainable competitive advantage of vacuum coating technologies and advanced materials. The estimated PE ratio based on the rolling 12 months earning is about 40 times. You could refer to the below timeline for the brief history of NTI. They first started offering surface solutions to the hard disk drive industry in 2000, and they entered the they established MVC in Shanghai in 2002. The following year, they started offering surface solutions under the advanced materials BU. And in 2004, the key players in the printing and imaging market started utilizing these surface solutions. A few years later, in 2009, they established NTJ in Tokyo. And in 2012, they developed the world's first FCVA inline system, and FCVA stands for the technology which they have a competitive advantage in. It's called filtered cathodic vacuum arc. In 2017, they commenced manufacturing and production operations at Shanghai Plant 1, and this is one of their 4 production plants in Asia. The newest business unit, Nanofabrication BU, began operations in 2018. And in the following year, in 2019, they established a JV with CYPR, which is China's largest piston ring maker. Next slide, please. So you could refer to the top left table for the IPO statistics. There will be a total of 658.35 million shares, and this is made up of 527.5 million shares held by the company's current shareholders and 53.63 million convertible note shares. There will also be 77.22 million new shares in the IPO. So at $2.59 per share, this amounts to a total market cap of 1.7 billion Sing dollars post-placement. As mentioned previously, the P/E ratio based on rolling 12 months earning is 40.4. So out of the 77.2 million shares to be listed on the main board, there are 73.4 million placement shares, while 3.9 million shares are under the Singapore public offer. Cornerstone investors had agreed to subscribe for 104.26 million shares, of which 77.2 million will be new shares issued by the company, while the remaining 27 million shares will be sold by Dr. Shi, the founder himself. As for the company's substantial shareholders, Dr. Shi and his spouse hold 377.88 million shares in total, and this makes up 57.4% of the total amount of shares. The subsidiaries of Temasek Holdings will hold 49.89 million shares in total. There is a total of 150.59 million placement shares, and lastly, 3.86 million shares will be under the public offer, and this takes up about 0.59% of the total number of shares. It was stated that for the first half of financial year 2020, the largest customer, which they have only identified as Customer Z, a global tech company, accounted for approximately 56.5% of their total sales revenue, and the revenue contribution is primarily in their advanced materials BU in the sector of wearables. The next largest customer is CYPR, contributing to 9% of the total sales revenue. Next, you could refer to the top right table for the NTI's key financials. Some points to take note: the revenue grew at a 2-year CAGR of 17.5% to 143 million Sing dollars in financial year 2019, while the PATMI rose at a 2-year CAGR of 15.2% to 35.8 million Sing dollars also for financial year 2019. The gross profit margin was 54.3% and the EBITDA margin was 39.2% for financial year 2019. The indicative IPO timeline is presented at the bottom right-hand corner, the timeline there. The Singapore public offer began last Friday on 23rd of October at 6 p.m. and will end on 28th October, which is this Wednesday, at 12 noon. After which trading will commence this Friday on 30th of October at 9 a.m. Next, I'll be passing the time on to Timothy. Thank you.
Thanks, Vivian. We'll just provide a short update on our Phillip model bond portfolio. So it's been 2 months since we launched the model bond portfolio on the 18th of August. Here's the portfolio at the moment. There's 10 bonds in total, 5 straight bonds with maturity dates, and 5 perpetual bonds. The overall bond portfolio has a total yield of about 4%, and there's a total of about 9 issuers, including Thomson Medical, Ara Asset Management, ESR Cayman, Fraser's Property Limited, Mapletree Logistics, SPH REIT, UBS, and Ames APAC REIT. We review this portfolio on a monthly basis. So and remember that this is not a portfolio such as a fund. It's just a recommendations list. So so you can actually purchase the bonds individually from this list. Next slide, please. Okay, so just a performance review on the portfolio. The portfolio met its objective of outperforming the benchmark fixed income index with lower volatility. So as you can see on the graph on the left-hand side, the blue line is the performance, the total return of the portfolio versus the benchmark index, which is the Singapore Fixed Income Total Return Index, which is the red line. So the model bond portfolio returned about 1.1% for the month, which is 0.8% higher than the IH SFI Total Return Index, which returned only about 0.3%. And also returns were more stable for the portfolio. Out of the 1.1% gains in the portfolio, 0.8% was from price appreciation in the bonds, and 0.3% was from yield. So how do we achieve this? Our strategy to achieve this outperformance is threefold. So firstly, we focus on the issuers. So one key thing about issuers is that we focus on strong stakeholders with substantial stakes, and this helps to lower the volatility in the portfolio, because these issuers can actually step in during financial stress, and this will help to stabilize the bond prices should that events happen. So you can see on the table on the right hand side, these are the issuers and the key stakeholders that they have. So Thomson Medical has Peter Lim, the owner, owning an 88% stake in it. So he's ranked about 14 richest in Singapore by Forbes. Okay, our asset management is 48% owned by Warburg Pincus, an established private equity fund. ESR Cayman, also owned by Warburg Pincus, also JD.com and SK Holdings, which is one of the largest conglomerates in Korea. Fraser's Property, 83% owned by TCC Group, one of the largest conglomerates in Thailand, and also owned by the third richest person in Thailand. And lastly, Mapletree Logistics, 30% owned by Temasek. With regards to the issuers as well, we also diversify the industries. So the bond portfolio, which has 10 bonds in total, has various industries, including healthcare, real estate development, logistics and e-commerce, retail and industrial REITs, and banking. And lastly, we look at the yield. So not only do we do a relative yield comparison to peers, so that we can look for relatively attractive valuations in the bonds, but we also keep the yields at a minimum of 3% to maintain the portfolio yield attractiveness. Okay, next slide. Okay, so this is just a table of the bond price changes for the month. So total price appreciation for the portfolio was 0.76% for the month. The highest performer was Fraser's Property, 4.25% bond, and the laggard was RI Asset Management, 4.15% bond. For the month, we maintained the holdings in the portfolio. So for those of you that are quite unfamiliar with bonds in general, you can actually contact our bond desk directly if you have any inquiries about any corporate bonds. So the contact is 6212-1818, and the email is bonds@phillip.com.sg for any of your corporate bond inquiries, or you can contact your respective trading representative. Okay, that's all from me. Pass the time on to Jinrong.
Okay, thank you, Timothy. So now I'll be talking about the US elections impact on the healthcare sector. Next slide, please. Okay, so for a brief introduction, the healthcare sector consists of several main industries, namely those providing medical services, medical equipment, pharmaceutical drugs, and also medical insurance. So the majority of the sector is actually being taken up by drug manufacturers, around 37.7% of the sector. Next slide, please. So we believe that near-term wise, COVID-19 actually has an uneven impact on the healthcare sector. On one hand, biotechnology and pharmaceutical companies, they may stand to benefit if they produce tests and vaccine for COVID-19. However, on the other hand, the crisis has actually delayed some elective surgeries and also reduced visits to doctors for non-urgent treatment. So we are also recently seeing a spike in COVID-19 cases in US. So the risk will be it may actually prompt some states to reimpose a restriction, like what we have actually seen in the case of Europe. Therefore, we believe that companies which do not have a foot in COVID-related development may continue to face uncertainty. But longer time-wise, if you look at the chart, demand for healthcare should remain anchored by an aging population. So if you look at the two oldest age band, namely those which is above 45 years old, so the two oldest age band account for roughly 42% of US population. So in this case, this demographic should provide a steady stream of demand in terms of pharmaceutical drugs and also healthcare service over the next 10 to 20 years. Next slide, please. So this is the US election policy overview. We believe that other than just looking at who will ultimately become the president, another key aspect will be the composition of the new Congress itself. Why is because having a unified government may increase the chances of pushing out aggressive policies, whereas having a split Congress may result in a stalemate, and a stalemate is generally deemed as a positive for the healthcare companies. So you can think of it in terms of, for example, a Biden win. We may see him putting more regulatory pressure on the industry, but without the required support from Congress, it will likely not lead to any structural change of the healthcare industry. And then this will actually remove any uncertainty for the sector, and the market tends to see it positively. Yeah, so this is the breakdown or a short summary of the differences in the policy between Biden and Trump. If you want to find out more, under the Stocks DNB report, there's a more detailed breakdown of the policy that may happen under the different scenarios. Yeah, but for the interest of time, I will not be touching on it here. Next slide, please. Okay, for private insurers, we believe Trump will be a positive. It's because he's determined to weaken the Affordable Care Act, or commonly known as Obamacare. So this act actually has various restrictions on insurers, such as having no coverage limit. And we actually see that during his term, he tried to repeal this ACA, but it was actually it faced resistance from the Congress itself. So he didn't manage to succeed in this case. So with his re-election, we believe that he will continue to further this cause, especially when he has some Republican support over there. And further deregulation will actually give private insurers better control of a premium. Whereas for Biden itself, his proposed policies is harder to determine the impact for private insurers because he's actually eyeing a government-run public option as an alternative for private insurance, which he call it Biden Care. So currently, we believe that under Biden, more clarity is needed, and hence the outlook for private insurance may be more uncertain under Biden. Next slide, please. In terms of drug pricing, which is another key issue for the healthcare sector, both Biden and Trump, they aim to lower drug prices to make healthcare more affordable. But we believe that Biden is expected to have a greater chance of success. If you look at the chart, during Trump's term, drug prices growth did indeed slow down, but prices are still largely increasing at an average of around 2% year on year. For Biden's approach, okay, his proposed approach is to allow Medicare to negotiate for lower drug prices with pharmaceutical companies directly. So this form of approach, we see a greater chance of success compared to Trump because Medicare is being administered by a federal agency. And with that, they may potentially have the power to take tougher actions against companies for non-compliance. Another key thing is for biotechnology industry. Even though they may not be spared from the clampdown on drug pricing, but we do see near-term opportunities because with a Biden win, we will likely see a ramp up of COVID testing. And we believe that investment in vaccine manufacturing should also continue regardless of whoever becomes the president. Therefore, biotechnology firms with a COVID-related exposure should continue to benefit in the near term. Next slide, please. Other players in the industry will include healthcare equipment makers, which may benefit more under Biden. This is considering that he has a plan to avoid reliance on other countries' supply. And he actually plans to manufacture more medical equipment to battle future pandemics. And the other players will be healthcare service providers. We believe that they will benefit either way, but more so under Biden with his expansion of Medicare and Medicaid, which will actually expand more healthcare to cover more Americans. In terms of Trump, he did mention to promote telehealth services to expand healthcare access. But we believe that the transition to telehealth will take place regardless of whoever becomes president. And this convenience itself may drive further demand for healthcare services. Next slide, please. So overall conclusion, we believe that future healthcare policies are closely intertwined with the composition of the new Congress. With a divided Congress, we may end up with little or no structural change, which will be largely positive for the healthcare sectors. If we see a blue wave, of course, Biden's ambition is more likely to pass. However, we do not expect any significant overhaul of the healthcare system over the next 1 year. Because the rationale is that we believe that the near-term focus for the new president will still be on keeping COVID-19 under control. And any regulation or major changes may be put on hold until the worst of the COVID crisis is over. Next slide, please. So here is a list of ETF which investors may look out for under a Biden or a Trump win. If you want to look at this table, you can actually refer to the report on Stocks BMD. Next slide, please. So now I'll pass on the time to Paul for SG Weekly.
Oh, okay, thanks, Jerome. Next slide. We go through the usual for week 44. We just go through the usual macro for last week. There wasn't really much macro news from Singapore. There was CPI, but I guess nobody cares. So long as it's within MAS guidance, it's not very material information. So there was some corporate news. We saw SIA announce the use of their rights proceeds, and based on just some back of the envelope computation, they probably have 3 months left from the proceeds of the rights. We'll show you a slide later. Marina Bay Sands, through US listed Las Vegas Sands, released their third quarter numbers. So we just took a quick peek at how Marina Bay Sands was performing. The purpose is just to get a read from getting Singapore results. So third quarter will remain weak. Third quarter Marina Bay Sands revenue was down 65%. They are at the operating loss of 25 million versus a year ago, US almost 300 million that they were making. So that's quite a big swing in terms of the profitability. The other news came out was the final HDB resale index. I think this is important not only because if you stay in the HDB, but also that the 1.5% rise in prices was the fastest since first quarter 13, and this is important because this is the fastest since the whole TDSR was introduced. We will give you a quick brief on Keppel REIT. I'm not a REIT analyst, but I'll just give you some of the highlights from the Keppel REIT's results. There were some very good numbers from the US. The existing home sales. Existing home sales basically refers to like resale, like resale home sales, something similar to Singapore resale homes, not those new launches. So that was up 9%, and the volume was almost a 15-year high, and also the home prices were actually up almost 15% on a year-on-year basis. So housing in the US is very vibrant. We'll just, since the US elections is just 8 days away, we'll just give you another take on just the contested election. What are the possible scenarios? It's actually very complex, but I'll just try and summarize it to one of the likely scenarios. The other thing, tactically, we remain cautious. I think we expect sideways movements for the market. I think the US elections is approaching. And of course, I guess the market would be worried that a close race is a risk. And also there's a lack of stimulus, the US stimulus, and also the pandemic globally is worsening. On the US stimulus, I think you can forget about it. The elections already coming in a week's time. We don't expect any US stimulus, and because the politics will not allow it. From the Democrats' point of view, they like Nancy Pelosi. You keep seeing her in the news. She cannot walk away from it because Democrats do not want to be blamed for not walk away from such a large stimulus. At the same time, they cannot also give Trump such a big stimulus just before elections, and of course will improve his odds of winning. So you just hear a lot of news. They will just keep talking about it, but they won't go ahead with anything. Then on the Republican side, as to why they themselves politically may not want the stimulus, is I think the talk is that they kind of gave up on the 2020. I think they most likely will lose, and what they want to do is they are targeting more the 2022 Senate or House elections, so that the Republicans tend to be more of a fiscal hawk, so they tend to be their supporters tend to be wary about government intervention, government stimulus. So they do not want to go into 2022 elections telling the people, why do you support such a huge stimulus? So rather than do that, they will just walk away from this such a large deal. Okay, in terms of the economic events, I think you can see probably the more headline grabbing event in terms of the weeks ahead will be the US GDP. It will come out on the 29th. I mean, it will just a lot of news headlines over it. In terms of our webinars, so today this week we will have, tomorrow we will have IX Biopharma, and also we will have this new company OEL Holdings. Okay, so if you have time, feel free to just register at the link below. Next slide. Okay, we'll just, as usual, we will run through the COVID cases, and the COVID cases is quite alarming. I think from a year ago, from a month on month, actually is rising to 34%. So just like mind-boggling kind of increase in number of new cases. And if you look at of course, Europe, we all know is skyrocketing. And even in the US, if you focus on the orange line, the latest number is, because it's on the left-hand base, so the latest number is 80,000. So if you look at 80,000, that line, so the US is basically going into a third wave, and even larger. You got first wave, second wave, whatsoever. But right now, the cases in US is worsening. The latest high, they really hit a high of 80,000. So we could be hitting another kind of third wave in the US, and even globally, the cases are already touching 445,000. Because this is a weekly average, so we don't pick up the latest number. The latest number we have is the 390,258. Next slide. I think Europe, we all know, if you look at just the blue line, France used to be 4,000, the peak. Right now is not hitting 20,000. So it's 5 times more than what happened in March. So it's 5 times higher than the previous peak. So, more and more cities in Europe are entering into lockdown phase. And obviously this is not good for the global growth, like we mentioned many times before. Next slide. Okay, in Singapore, the numbers are good. Ignore the title. I think we almost had 1 week of 0 community case, but somehow there were 2 community cases at the airport. I think Terminal 3, there were two cases. So I guess that also highlights the risk of imported cases. The authorities mentioned that we may enter into phase 3 this year, assuming the case count is down and so forth. I think one real test will probably be this next few days. We're going to have our first major conference, Singapore Energy Week, I think starting today. And then they're going to use antigen tests to test 250 people. Just a highlight, I know there's one question on Clearbridge. So antigen is almost like your PCR test, but they test the protein. So you can think of them like a PCR mini-me. Because the PCR will test the genetic material of the virus, whereas antigen tests some of the proteins. I think it's like those spikes that you see on the COVID-19 virus itself. Next slide. Okay, just to highlight, as we mentioned earlier on Marina Bay Sands, I guess unless you're an investor in Las Vegas Sands, but this is just to get a glimpse of how Genting Singapore may perform in the third quarter. The market share between Marina Bay Sands and Genting is sometimes 50-50, 45-55. So their performance more or less move in line. So anyway, the revenue is down 65% this year. It's actually a big improvement because second quarter was horrible. Second quarter, they only generated 23 million. And because as you know, the casinos were shut. They announced that the Marina Bay Sands announced that they had adjusted EBITDA was positive, but sometimes we can't really get details what do they adjust. It could be just adjust whatever expense they don't like. So we don't really pay much attention to those numbers. But operationally, they faced a loss of 20 million. That rolling volume, one of the reasons why the casino takings is down, the borders are closed, so there'll be no tourist gambling. But rolling volume basically refers to the VIP. So, when a VIP exchange the chips, so that's how they calculate, could be like few hundred million, even a billion sometimes. So the rolling volume or the VIPs going in to exchange chips is actually down for Marina Bay Sands 80%. So, I mean, the VIP business is just really, really bad, because there's no foreign tourists. And the one that's holding up casino takings, I think just for your interest, if you're actually growing, is actually the slot machines is actually doing well, because it's doing better, relatively better than the others. So the tables are also still very weak, and only the slots are performing better. Next slide. Okay, anyway, just a quick look at SIA. So the table on the left is just to give you some color on the passengers carried. So in September 20, for the month, the passengers carried by SIA was 32,000, or roughly 1,000 a day. A year ago, same time, there was 1.8 million, or 61,000 a day. So you can see the drastic decline. The table on the right is just the announcement. One thing good by SIA, they announced the use of their rights proceeds. So in 2nd June, they raised about 8.8 billion. You can see at the bottom, some of it was new shares and then the convertible bonds. So every month, every 2 months, they actually disclose how was the proceeds used. So the first use was to pay back your family banker DBS. Then the rest of it was to pay OPEX, fuel refund, some minor aircraft purchase. But you can see that right now the balance, I mean, just doing some basic maths, it's about 2.6 billion left. And if you just take it over, they roughly spend about 900, the burn rate about 900 million a month. So they probably have like 3 billion, 2.9 months or 3 months left in terms of what they raise in rights issue. I know some of you might be asking also, what does this mean? I mean, your guess is as good as mine. I don't cover SIA, but I think they either need to borrow more, take another 2 billion from friendly banker DBS, or they have to do another capital raising. Maybe issue more mandatory convertible bonds. But again, I'm not sure. I'm just wanted to highlight that. That's all. Okay. Okay. Next slide. Okay. This just to update everyone on the HDB. I guess even if you're not a property investor, you might just be interested in that, I guess. Anyway, from 3rd quarter 2005 to 2013, we enjoyed a huge surge in HDB prices then. But since the TDSR announcement and of course there were other restrictions too. Since the TDR announcement in 2nd quarter 13, HDB prices has been weakening, but it started to recover since the middle of last year. Although it's quite small, it's still 2.4. But one of the reasons is that, of course, the housing grant up to 160,000. And the pandemic has also caused delay in BTO. So some buyers have turned to the resale market rather than wait for the BTO. And the third reason is that the minimum occupancy period, 80,000 eligible have already met their minimum occupancy. So it doesn't mean all will sell, but it will just add some vibrancy. The importance of this is just that a higher resale market price index will be good, because it will help the private property as HDB as there will be more HDB upgrade demand. Next slide. Okay, this is nothing much. It's just the US market. I just wanted to show if anyone is interested that the US market is just very vibrant, the housing. Next slide. Okay, I'll just run through Keppel REIT. Again, I don't cover this stock, neither am I the REIT analyst, but let me just run through. So Keppel REIT has actually 10 office properties. In Singapore, they have the famous three. I think some of you may even be the tenant, OFC, MBFC, ORQ. The first bullet point, because UBS is leaving, ORQ. So there was a lot of questions on it. But anyway, what they said was that they're looking to maybe fill it up by 50% by year end. Okay, there are three things to note off from the results, at least from my point of view, is that I think the DPU can be maintained. DPU is roughly, I think 2.8 cents, or the yield is about 5.3%. I mean, the three reasons why we think they can maintain, I think the first one is the easy one. They mentioned that if there's any weakness in the first half, they can take capital gains. Because they sold Bugis Junction for almost 300 million gain in November. So they can actually use some of these gains to kind of prop up the DPU, to at least stabilize. So that's number one. The second reason is the distributable income is actually quite stable. You can see the bullet point on the arrow on the left. So the distributable income actually was up 4.6%. So it's stable. And then the third reason is any major new supply will only come in 2023. And most of their renewals is 2021, 2022. So that are the three reasons why I think their DPU should be stable. But anyway, just look back at the table on the left. The other interesting thing is if you look at the whale actually jumps out. I was also quite curious how can they raise the whale from whale is the average lease of, that means the average tenant in Keppel REIT, they have 5 years lease. So the reason is because they actually prop up they prop up because they sold one Singapore, they sold Bugis Junction, then they bought 2 more Australian. The whale in Australia is about 9 years. Singapore is about 3 years. So because of that, the whale is up. Occupancy, so the good thing is actually office in general much more resilient. I think they kind of tapered the most office assets, I think, are holding very well in view of this pandemic. I mean, the vacancy hardly changed. I think I leave the rest for you to read. The other thing is just if you look at the demand bullet point, we just wanted to highlight that one of the a big source of demand coming from, they mentioned, was from the large Chinese tech. Initially we read a lot of it by newspaper, but we just wanted to make sure. But so it's actually real. I think Alibaba already bought half a building. Then ByteDance is looking took up space in ORQ. So ORQ is of course a Keppel REIT. They didn't say how much, but they did say that I think it's much more than the Bloomberg even quoted. And the other thing is that Tencent is took up space in Justco, and Tencent is after they leave, because Justco is a co-living, something like WeWork. So once they leave the space here, they will also take some office space. So Chinese tech demand is quite a healthy development for the office sector in Singapore. The last bullet point is just that with Keppel also announcing news that they want to sell assets. So Keppel Towers, no, but Keppel Bay Tower is probably one likely asset that could be by the sponsor that could be injected into Keppel REIT, because they just completed the lobby renovation. Next slide. Okay. Anyway, this is just to just for your reference. The office supply, all this comes from Keppel REIT. But I think there are two things to note. So like we mentioned, in Singapore, the typical office average lease period is 3 years. So this is in a way positive for Keppel REIT. So you can see the 1070, the orange line. So you can see right now the market rate is about 1070. But 3 years ago, on average, most of their leases will be on the 940 onwards. So because of that, because any renewal was done compared to the rate 3 years ago, so some of the renewals will probably be 970. Then as the chart moves out, some would be higher, 1050. Then so you get that benefit because the 3 years ago the rates were lower. And the other thing is that you saw the big collapse in average grade A rent, all the way down to $9. One of the reasons is because of the rate chart. There was a huge supply in 2016, 2017. So in the next few years, we don't get that. There is supply, but most of the 2021, 2022, the supply and demand more or less kind of even out. The demand here, we're just taking the last 5-year average. So it's only in 2023 that you might have to worry a bit on the office, because that's when the big ones come up. Mainly you can see on the table, the Central Boulevard Tower thing by IOI. That's the big 1.3 million square feet. So that one is probably the one that's going to frighten all the office assets. So that's only in 2023, there's the big surge in supply that to worry about. But from here to now, it looks kind of balanced for office supply. I'm referring to grade A office supply. Next slide. Okay, US Senate, okay, this is very noisy. I'll just go through. The important thing is the dates. So in case there's a contested election, and hopefully not, contested election is only if the race is very close. So election day is 3rd November. I think probably the whole planet already knows this. The thing to watch is the 14th December electors. That's when all the states will kind of vote and decide who will be the presidential, who should be the presidential candidate. Then 6th Jan is when the Congress count. Then Congress will count all these votes that's been sent. It used to be very procedural, but actually this is going to be the most fragile timeline if there's a contested election. So one possible scenarios, there are many scenarios, but one possible scenario would be like this. Just give you an example. So if let's say there's a state, I think let's say you take Pennsylvania. So Trump may claim a victory in Pennsylvania if the in-person, those people who go physically to vote, and he's taking a lead. So if he takes a lead, then he could actually stop and say, okay, we're not going to count all these mail-in ballots, those coming in by mail, because he actually did that in Florida, the Senate race. He actually told, because the senator that was running for it was actually losing ground when they were counting all the mail ballots. So he actually said, don't count anymore for those ballots that are coming in by mail. Then as a result, so because in the US very unique, they got the governor and the legislature. So the state legislator, let's say you look at Pennsylvania, the table on the right is Republican. So the Republicans may say, okay, all these mail-in ballots are fraud. I think we should just count the in-person, and then we are the ones that won the election. But then of course, then Biden will say that he won. So on the 6th of January, there could be actually 2 sets of presidential candidates that will be sent. So Pennsylvania could have the Democrat governor will send and say Biden won, then the Republican legislator. I know very confusing, but I'm just telling you one scenario. This is like kind of the worst case scenario. I won't bore you with the details, but that is probably one possible way the contested election, because they may not, let's say that basically see all those ballots that are coming from mail is illegal. The reason why this is important is this is going to cause a lot of chaos in the stock market. If there's a lot of contest, because all this will then lead to protests, and it would just cause a lot of havoc in the stock market if all these things happen. Okay, and next slide. Next slide. Okay, with one more week, and hopefully I don't have to talk about elections anymore. With one more week, we just did 2 slides to update everyone on the election. So we wanted to see how did Biden versus Hillary Clinton in 2016. It looks a bit worrying considering that actually Hillary Clinton, like 1 week or 2 weeks just before elections, her lead over Trump was 6%, that 5.9. Of course, Biden is higher at 8, but again, it makes us all a bit nervous because of the polls, right? But the good thing is, there are 2 good things about this over Hillary Clinton in terms of the poll lead, is that number 1, Biden is higher, of course, it's 8 percentage points. And number 2, if you look at within the green bar, Biden has never crossed below 6. He's always been 7.8. So his is much more, his lead over Trump has been more consistent. So so there's a bit of a lack of a worry over the accuracy of the polls. Whereas if you look at the red line for Hillary, it's like all over the place, can be 6, sometimes 0, sometimes 4. Yeah. So that is one reason. Okay, next slide. Okay, just one final thing. So we know that the polls are in his favor. So we just wanted to have a quick look at the swing states. Okay, so anyway, this is basically the lead that Biden has. So let's say we take Michigan. So Biden has almost 8 percentage points lead over Trump. And the reason why we put that green box there is that when we look at the 2016 elections, the usual error rate has been as much as 3 percentage points. So anything below it is, you can on paper kind of attribute it. There could be some error in the election. So Florida, North Carolina, Arizona, the swing states, these are the ones that could still be up in the air, and actually Trump may win. But the ones that can win clear cut that he has a big lead will be the ones the Pennsylvania, Michigan, and Wisconsin. So these are important because Hillary needed 43. She lost all these 3 major seats, the PMW, this PA, by less than 1%. So these are the 3 states to watch, and there's still a good chance that Biden will win because he has such a commanding lead in polls in these 3 states. So far everything's on track that Biden will win. I mean, just based on the latest data that we have. Next slide. Okay, because of the results coming out, we'll just give you what are the main results coming. In yellow will be the stocks that we cover. Some of them may not be full blown, but just be update. I think for this week, the big one will be Wilmar's results. And I think that will be the biggest, and Keppel Corp's results coming up this week. This is just for your reference. I mean, you can take a photo or whatsoever, or even take the slides later. Next. On the first week of November will be all just banks. All the 3 banks will be coming out, UOB, OCBC, as you can see. And again, this is just for reference. And of course, our ventures results will be coming up next week. So next week will be all the really large caps on coming up. This is just for a reference. Next slide. Okay, I think we've ended, and we'll welcome any questions that anyone may have. Thank you for your attendance. Thank you.
The first question is, why is the share price of CMT going down when the merger is supposed to be good? This is a very good question, but unfortunately, we can only speculate. I think it has to do mostly with how the Singapore market is trending. That would be my best guess. The S&P is also down, so and you can see that actually almost 50% of the REITs are in the red. Yeah, so that would be my best guess. Second question is for Paul on SATS.
Okay, the question is, any change in the outlook for SATS? The price rose almost 20% since last Monday. Yeah, I think that's the problem. Mine is the lowest target price. I'm the only one who got a sell call. So obviously this looks bad on me. But I have no change in my outlook. I think we're still negative on SATS. Our preference has been to play on comfort. I'm not sure. Maybe there's some deal happening. I really I have no idea. Not heard of anything in particular. But operationally, I think we've seen how SIA is doing, and I think and in the annual report, I think SIA is I believe 40% of this a customer and accounts for 40% of the sales. I think roughly, if I'm not mistaken, I think you can get it from the annual report. So if your customer of 40% is not doing well, I'm not sure how a SAT's going to do well. I mean, that's why we still have a sell call on SATS. Okay, there's one question. What's your technical analysis on kitchen culture? Just regretfully, Weiren is away. Is on reservist, so he can only come back on next week. So we can't do any of our technical analysis as usual. So he can probably continue it on next week. Thanks.
Okay, the next question is on whether or not it's good to take up MLT rights. We actually don't have any coverage on MLT, so I can only provide some generic color. We like MLT's resilient income stream coming from a large asset base, and also that they are diversified in terms of their geography and trade sector mix. As observed, MLT is also opportunistic amidst the COVID-19 pandemic, as it aims to be the largest industrial REIT in APAC. Also guided by the management, there's also another smaller acquisition of 100 to 200 million expected in the next 6 months on top of the 1 billion portfolio and 114 million asset acquisition that just actually happened. But I think all things aside, I do think that existing investors should subscribe for the rights issue to prevent dilution, and this should actually be contingent on your comfort level in accumulating more of MLT's units. Yeah, that's all from me.
Okay, another question. Is it a good time to buy AEM? Because we don't cover AEM. I always have issue trying to understand their business, but I think it looks okay. I think the whole semicon industry is doing very well. I'm just telling you holistically, and they raised their forecast. So it looks okay, but again, we don't have really detailed analysis to kind of give you. So I can't really help you on that. Yeah, sorry.
Well, there is a question on NTI. Any idea who are the major competitors of NTI, and does NTI have an edge over them in terms of technology, and how much market share do they think they can carve out? So firstly, for the first part, the major competitors, They have some major competitors. Firstly, for the advanced materials, that would be a Swiss company called OC Olicon, and I think this is a Chinese company called Vitalink. Then for nanofabrication, there is quite a few, and also for industrial equipment. I won't go through all of them, but yes, they have a competitive advantage over most or all of these other companies because of their patented FCVA technology, which I mentioned previously is the filtered cathodic vacuum arc. So it's a advanced vacuum coating technology in the sense that it enables this coating deposition to be performed at room temperature. And this is compared to the conventional vacuum coating technology, and it is also more cost effective. And because of that, it would open up new markets that were previously inaccessible by the conventional coating technologies. With regards to the market share that the NTI would cover, they didn't provide an explicit number, but they have been making efforts to capture more market share over the past few years, and also in their outlook. So for example, they are intending to capture more of their customers' value chain through both vertical and horizontal integration. So I'll just give one very simple example. For Microsoft, the Surface tablet logos are made by the NTI, and they are also responsible for the end-to-end production, from laser cutting of the stainless steel piece to the application of these proprietary advanced materials on each logo. So this is something that would enable them to capture more market share. And also for the nanotechnology, they have this TAM technology that would also allow them to capture greater market share. Yeah, so apart from that, there is also the 5G networks that will be coming on, and also IoT optical sensors, medical lens, and they will be entering all these into production of all these materials. Yeah.
Oh, sorry. Hi. We still have a buy call on city development. No change, and our target price is. Sorry, our target price is 1068. Yeah. So I think what happened last week was that I think there was a bit of a sell down in CDL. This was because of the resignation of Kwek Ling Pik, who is the cousin of the chairman Kwek Lim Bing. Yeah, I think one of the two reasons cited in his resignation was due to disagreements in the investment in Sincere, which is a property developer in China, as well as how the MNC privatization and reorganizations were taking place. So I guess I think that actually affected the share price slightly. But overall, there isn't really a change in our outlook. I think that was just the market reacting to that piece of news. Yeah, that's all for me. I can pass it on to Paul or Eugene.
Yeah, but I guess they also want to know like how is Sincere doing. But I mean, if you don't have, it's okay. I think that's the bigger concern people have on Sincere. But I mean, let me just try to answer why UG Healthcare is down as rubber glove is needed during COVID. I think operationally I can say is that it is never been better. I can only speculate why. Maybe there's some vaccine news and a lot of the market as a whole is all down. So, but for me, I think it's an opportunity at this level. The results should be coming out for both Riverstone and UG Glow, I think the next 1 to 2 weeks. So that could help the share price. Again, we do not know what are the numbers, but like you mentioned in the question, the COVID cases this way, the demand has never been stronger. This is another question on AEM. AEM's results also should be coming out. So maybe I can give you more color once the results is out. So the question is, AEM is going down, but the semiconductors industry is positive. Any comment on why? I think all those, even most of the, I think it's almost like a risk-off scenario right now. So most of the counters are all down. I don't think it's anything fundamentally driven. I don't think operationally anything has changed. And we will try to give you more updates once we attend the AAM, and then we'll try and give you more color on it. Okay, why is Wilmar price not reflecting KYA IPO success? I guess the news is already out, the listing is already out, and they only listed 10%, if I'm not mistaken, of the shares. And whatever value, I don't know, you can do some breakup value, but again, it's only 10% of the shares. And usually there's a huge discount to any valuation you can, if you want to kind of do some breakup value, right? The KYA is, I mean, you can put in some discount, but again, it's not really a huge listing. It's only like a very small float. So that's one of the reasons. And I think most likely is also the stock already ran up since the news of this KYA, and probably my guess is just selling on the back of this news. It's already been done. This thing has been talked about for almost a year, this IPO. And it will be back to like how Wilmar performs operationally for the stock to move. There's a question, thoughts on how Alibaba is expected to perform since they will be buying into Ant Financial confirmation. Also, how do they try to purchase? We can't answer Ant, we don't cover. I think you might have to ask a dealer and maybe speak to the Hong Kong desk, because we don't really have answers to them. Okay, I will try. Okay, this one I will try to help answer. Because many people were asking about the NTI, whether to subscribe. Will NTI be too expensive at PE of more than 40 times can subscribe? Okay, we've not met NTI, like Vivian mentioned. So we're not sure how is the forward guidance. So the forward guidance, maybe it could be only 20 times or so. And can it be subscribed? My own view is can. The main reason why we think can subscribe is because the float is so small. I think the retail participation, the public float that they're giving is only, which is quite insulting in a way. It's only 0.5% of the whole market cap. It's like it's almost like they don't want any retail participation. So that's quite insulting in a way. But anyway, the good thing is that with the float so thin and most of it placement shares at 259, so everyone's cost more or less the same. So I think there's an opportunistic to subscribe to it, because there's just so few shares out there to be sold, I guess, in a way, although they never really disclose the full shareholders list. I think there's like a missing, I read the whole thing, there's probably like missing 15%. I'm not sure who they share, because they only disclose the major shareholders. There's still some shareholders that did not disclose. But you definitely can subscribe. I think this one, because there's so few shares out there for the public. Probably you can get it. Next question, do you have an update on ClearBridge since releasing your report on 31st August? Still a buy? Okay, ClearBridge is a paid research, so we actually, just as a disclaimer, we receive compensation for the report. We think it's still okay. A lot will be driven by Biolytics. Biolytics is still selling their antibody tests. And if you go to the Biolytics website, you can see that Biolytics is also selling antigen tests. So that's the reason why we mentioned antigen. So maybe and with Singapore using antigen, then hopefully they can get qualified and also sell an antigen test. So I think now antigen is probably the most popular way to test, because the problem with antibody test is after you get the result, what are you going to do with it? Like, how long does the antibody last? So he has antibody, so yeah, he's going infected before, but what can we do with that information? But antigen is a better way to test, so that you know whether this person has it or not, and also faster than the PCR. So it will be a much more popular, like the Singapore government is also moving. So I think ClearBridge will be relying a lot on the Biolytics. So, but with no change in our target price, and just to cut the story short. Can you view your Far East? I'm not sure anybody can help on Far East Hospitality Trust.
We don't exactly have a view on or a preview of Far East coming results. We can just speak generally. So for Far East, actually most of their leases, rather their hotels are on master lease. So the one good thing about Far East is that is this particular thing where they have a lot of leases that are master lease. That means it provides like a floor to their income, an income protection, minimum income. Yeah. So I guess I think the management did share that if let's say we just being the most conservative bear you can be, I think they will still be able to deliver an NPI of about 4.7%. Sorry, a DPU of 4.7%. But this is like assuming that there is no turnover component or etc. Really just minimum. Yeah, so I guess there's a good part about FEHT. So but we don't really have much insight. What we do know is that even though they have 2 hotels that are on Sentosa Island, which can actually potentially benefit from the staycation demand, we understand from the company that actually it's a very small portion of it, and it's very the amount that it's supposed to contribute is going to be very insignificant. One of the assets, I believe, is the Outpost. It's only a 50 room outfit. So with because of the layout of the property, the kind of and due to social distancing requirements for that particular property only because of the layout, they only can operate at 50% capacity. So that is another consideration. So overall, I think the thing that's really for Keppel for FEHT is the minimum rents. I'll take the next question on TP for Keppel DC REIT. Okay, so I would like to reiterate that the increase in my target price from $2.57 to $2.91 is due to the assumption of a $500 million acquisition. Yeah, so without the acquisition, my TP would have still been the same, but factoring in this hypothetical acquisition of $500 million, that would result in an increase in target price. So why did I factor in this $50 million increase acquisition? This is because actually since earlier in the year already, KDC has already been saying that they are in advanced talks, advanced negotiations for acquisition from third-party players. But as you can see, over the COVID hit and they still have not managed to close it. And of course, this is based on my assumption, $500 million. It could be anything. It could be 100 million, 200 million, 300 million, 400 million. And in fact, some other brokers, I will leave you to do your own scavenging to see. Actually, they have also incorporated their own kind of estimates. So my estimate is around the $500 million mark at about 6% NPI yield, LTV of 30%. So that is that's the reason for the increase in TP. I'll pass it on to Jie-Hui for Yoma.
Yeah, there's a question on whether or not my outlook for Yoma changed. So I think for Yoma, more or less my view still remains unchanged. But I think, okay, how do I put it? For Yoma, actually the number of COVID-19 cases actually came down quite a bit since their lockdown 2 weeks back. So more or less the situation is more or less controlled. But I think for lockdowns wise, we still do think that it will impact their different business segments quite a bit. Like for property sales, we might actually see like a slowdown in sales. In terms of Wave Money, like their financial services side, the transactions wise will be impacted for their over-the-counter transactions, But in terms of digital services, we are actually expecting a growth because of more e-commerce transactions. Yeah. And then I think these two are the key segments that we are looking at. And yeah, for now our view still remains unchanged.
Next question is on CapitaLand. Yes, still a buy. Nothing much has changed in that respect. So yeah, still a buy. Unfortunately, we cannot answer the question on CDL, the technical analysis of CDL, because Weiren is away. So we'll hold. You can try to repost these questions next week. I believe the AEM and HPH trust is also a technical question, so we can't answer that. For IFAS, Bikon can speak, but I also can speak for us because I think we have no target price.
It's okay. I'll do it. For IFAS, we don't cover, but just to share, okay, the valuations now for IFAS is 40 times. If you kind of normalize their so-called year-to-date results, but do remember, this year has been a good year for brokers. I'm not saying about ourselves, but at least for IFAS as a broker. So there's been a lot of transaction income, and these are not recurrent income. So so you can say in a way that the earnings is a bit there's a kind of the earnings for this year, even at 40 times, the earnings is a bit buffed up by the recent buoyant stock market. So you're not sure whether it will happen, it can continue next year. So number one. Then number two, there are two things to watch for IFAS. I think maybe that's why the price is up. Again, we're not very sure, but because there could be two announcements by them. Of course, digital banking in Singapore, there could be one. And also, they are bidding for this EMPF system in Hong Kong. They didn't give much details, but it's a 7 to 8 years to kind of run this platform. So if this happens, we can only assume it's very positive because you got 7 to 8 years. And it's the equivalent of a CPF. So you're running almost like the CPF equivalent platform in Hong Kong. But again, we have no idea because no details have been given whether they can bid for it. But I think they're partnering with PCCW. So maybe the market is just riding on this. But if you just look at the earnings alone, it's already trading at 40 times. So it looks a bit pricey for us. I mean, and the recent jump in the recurrent income, because they did very well, they got like almost 600 million inflows this quarter, which is huge from the unit trust. And one of the reasons is also because the 1.5% upfront charge for CPF funds will end. There'll be zero upfront charge, I think effective 1st October, if I'm not mistaken. So there was a bit of front loading is not the right word, front loading of funds into their unit trust platform. So this kind of turbocharge their numbers a bit. So we just think that in terms of PE wise, it look expensive because the numbers not sure whether can they repeat that 20 million net profit into 2021. Again, this is just our view. We don't cover, and this is just back of envelope kind of estimates that we did. Okay, I hope that helps it because we don't really look at IFAS. Okay, the next also, is that going up too fast and should it now, I guess, sell? I think if you have it, just be a bit more cautious, I guess. How can we apply N Finance IPO? Can you send us an email? We will get the right person to. How can we apply for N IPO through Phillips? Yeah, can you just send an email to anyone in this slide except the first person? Then we will try to kind of help you answer that. We will send the right person for you to speak to. Nanotech on, are you able to comment on their patent rights? Or this one we really kind of, the prospectus not the easiest thing to read. On the patent, we really don't know because they never gave a briefing, so it's hard for us to give you some views on the patents, like enforceability. Is it on the US only? Can it be? I'm really not sure, but yeah, but I guess if customer Z, which I think we all kind of can figure out who this customer Z, which accounts for 56%, has to use them in, I think they probably got some strong patent rights. I think if you got no strong patent rights, these are huge tech firms. If they can get away, I'm sure they will just make it themselves or not pay you so high. So I think we can only guess that the patents is enforceable, I presume. What is your view on Frasers Logistics and Commercial?
So for Frasers Logistics and Commercial, sorry, we don't really have much of a view on that. Yeah, because we don't really have coverage on it. We don't really have a view on it. I think that because it is a diversified portfolio, with majority of it actually in Australia. So the commercial side and the logistics sides, I think they are mostly stable, one of the more stable asset classes in this situation. So that will be one of the benefits of FLCT. Yeah, but apart from that, I don't really want to comment too much because we don't follow it that closely. things. Okay, yes. All right, I saw another question on Ascendas REIT. Yes, for Ascendas, actually, if you look at the share price, yes, it's been trending down in the past few weeks, months. But I think overall, our view on Ascendas is unchanged, and some of the reasons why we like Ascendas is because of their very diversified portfolio, of course, and I mean asset concentration risk is very low, as well as tenant concentration risk because of the sheer number of tenants in their portfolio. I think it's 1,900 tenants. So the largest tenant is like Singtel, which is a 4% contribution to MPI. So apart from that, I think while you see a lot of REITs actually picking up the acquisitions, I think we can expect this from Ascendas as well. And as you know, if you're looking back at the past 2020, 2018, 19 kind of acquisitions, they have been known to enter a new market in a very meaningful way. So this will give them an advantage, especially when it comes to active management of their assets. So in 2018, they went into the logistics portfolio in the UK. So that was a relatively big move. I think it was 28 assets. And then 2019, they entered the US business park space. So this year, I mean, they haven't done anything yet. And as we know, depending on which countries that they're looking at, they might still be facing some sort of like travel restrictions. But I think this is what we can expect from Ascendas REIT, that they will continue to acquire as well when the time is right and when they can. Otherwise, their portfolio is stable. Yeah, and they have several assets that they are looking at redeveloping and repositioning. So that will actually help to lift some of the revenue for Ascendas REIT. Yeah, so we actually do like Ascendas REIT. I think we have an accumulate call on Ascendas. That's all for me.
Yeah, but any for those who don't know, I mean, just for your info, the warehouse space in Singapore in general is doing well. If we have not highlighted before, because the authorities is stocking up on 2-year contracts. So a lot of the warehouses are being filled up with masks, PPE, a lot of the PPE stuff. So don't open the wrong door. All the PPE will drop down. But anyway, they were also stocking up on dry goods, a lot of rice, a lot of flour. So a lot of those lower end warehouse that used to maybe 50 cents, I guess, now is already up to $1. So warehouse space in Singapore is doing very well. It's filled to the rim, I guess, in a way. Okay, first sponsor, I'll just help check here. Okay, the reason why we can't say too much on this question, first sponsor group reported their third quarter results. Any change of view for the last report? Thanks. Because, we got this compliance thing where we cannot mention about our report if it's not been publicly issued. So sorry for that, but we can just tell you from the results briefing, everything looks good. Everything except, of course, hospitality is weak, but the other divisions look okay. I think the Dongguan is, they have a property development in Dongguan, and that is selling well. It's like sold out even before you launch anything. It's sold out. Some projects where you can actually only sell for in 2 years, so people have actually kind of bought it, and despite only able to transfer the land in 2 years. So Dongguan is an ultra hot market, and I think they got like 3 to 4. I think 3, if not being 4 projects there, or three live and 1 more ongoing. So they're doing well. The hotel is of course weaker. I think because they got hotels in Europe. So that is going to be the weak spot. But we think whatever comes out will be offset by the strength in your hotel, in the property development in Dongguan, number 1. Then number 2, their property financing, which is kind of money lending in China. That's also doing well, number 2. And also they are landlord in offices, so that is also doing well. I mean that's stable. I wouldn't say growing, right? Because it's office right now. So I think it looks okay right now, but we can't give you any details on the report until Hui releases it. Okay, the next one, any comments on CSE Global? I'll leave it to Terence to give you more details. I'm not sure if he can, because we don't cover, but he's met them before, but he has dropped. But the thing is, CSE, one big exposure they have is the US shale, I think shale is one of their customers, so maybe that could be reason. But I'm not sure, Terence, if you have anything you want to share.
Yeah, thanks, Paul. So most of you all will be aware that recently Heliconia took a stake in CSE Global. So when we met them, what we understand from management is that Heliconia is working very closely with them in terms of how to create value in the business. But there's nothing concrete at the moment. They are trying to reduce their reliance on oil and gas, like what Paul mentioned, and try to diversify a little bit more into infrastructure and their mining business. But those are at this moment less than 20%, 20-25% of their business. So even as they try to reduce their reliance on oil, that is not likely to happen soon. So and they will have to wait for they will still have to depend on the oil majors contracts. Of course, one of the things that they always tell investors is that their capex is not dependent on the operational capex that people will be familiar with. Is more maintenance capex. That's why they say it's more defensive. But when your customers are down, it also reduces their ability to engage in very ambitious or projects as well. So that will affect them. So we think that as long as oil prices remain down, that they could see their operations and financials suffer for a while. Let's say we want to emphasize that we don't have a rating on them. So also does do your own research if you're considering a position. That's all from me.
Okay, we'll take last two questions. Thank you everyone for all your questions. Next one is, should I still hold red-colored StarHub? Any upside potential or dividend? Okay, the green, okay, it used to be green, right? I mean, their logo was green, but okay, the reason, okay, we have a neutral call. Just to answer, any upside potential on dividends, is going to be challenging for them the next 2 quarters. So you can just assume this stock won't move for the next 2 quarters. The reason we mentioned many times, the roaming. So roaming is a big drag. Roaming is hurting almost 1/3 of the business, 1/3 of, no, 20% of revenue roughly, although they never mentioned, but Singtel is about 20% of the revenue. And because it's a higher margin, so you can just assume roughly, 1/3 of profits is down, or no, their profits will be down at least 1/3 because of the reduction in roaming. And this will drag on, I think, the next 2 quarters. So 3rd quarter will be bad, then 4th quarter also will be bad, because 2019 you got this business. So it will only look a bit better, more stable in 2021 1st quarter. So I'm not sure, but just expect it not to go anywhere the next 6 months. That's my view. And dividends, they've not guided I think the dividends they've already guided, and it should be, I think they said more than or equal to 5 cents. So that they've guided, so that is fine. But in terms of the share price, nothing much going to go on for this stock. Yeah, just expect it to be flat the next 6 months. Whether it really collapse again, I don't think so. I think more or less is already stabilized. I think most investors really know about this roaming issue. Chun Rong, you want to help on the US stock?
Yeah, sure. So the question is which US stock to buy if I'm neutral, apart from health vaccine share. So I think if you do not want to look at the healthcare sectors, in terms of valuation play, there is 2 sectors. One is energy and one is financial. But in terms of energy, yes, it can be a good valuation play because it has been punished in terms of the COVID outlook, in terms of the oversupply oil situation. And also because of, with a Biden win, and then he's shifting towards clean energy, and potentially there may be further reduction in the oil. But in terms of, so it's purely more of a valuation play. But we are more positive in terms of financial. Okay, even though the recovery period may take quite some time, okay, especially with all these resurgence in the cases, okay, but we believe that they have mainly factored for the bulk of the loan allowances. Of course, moving forward, they may start to build up again if the COVID situation starts to escalate. But as of now, the loan allowance is, quite comparable to the 2009 financial crisis. So of course, if you are looking for a valuation play, then you'll be looking at the bigger banks like JP Morgan, Bank of America. And other than that, I mean, if you're looking for a more growth play, you can actually bet on the infrastructure project, which Biden is aiming for. I mean, Trump also has an infrastructure plan. He aims to boost building of the transportation and also 5G. But for Trump, he has been bringing up quite a lot of times, but ultimately it didn't really translate into further action. So we believe that Biden will be the one that will actually translate it to concrete action in terms of infrastructure project. So if you're looking at infrastructure, then of course there is Caterpillar, there is Vulcan Material. So Vulcan Material is like do your the road. If you're building road, you need those asphalt, right? Those asphalt are like those black thing that forms your road. So Vulcan Material is the one that provide that. But the key thing is that infrastructure wise, we believe that near term they will still be focused on tackling the COVID. So the infrastructure one, we may be seeing a further threat in terms of the timeline for the projects to carry out. And of course, usually this kind of projects will take some time to will definitely take some time to play out. So in terms of this, you actually need to have the holding power. Yeah. So this is my take on this. Yeah.
Okay.
So,
Last one on Manulife REIT. Yeah.
The last question for today will be on Manulife REIT. The question is, Manulife has been down quite a bit, and is it a good time to buy now? So for Manulife, I'll call Manulife as a buy, and actually there's no change in our outlook, and we still like Manulife. So main reason is because of the long WALEs in the US office space. So for Manulife, the portfolio is about 5.7 years WALE. And this actually translates to very low expiries in the earlier years. So 2021, 2022, very low expiries in the single digits. And so while if you are conservative and you think that there might be some near-term volatility, etc., and you think that rents will take a hit, then this is also very good, because that means low expiries means there's a lower chance for your expiring rents to be committed at a lower rate, or even to be expired and not renewed, that means to go vacant. Another thing is that we like to point out that for remote working in the US, they've been one of the earlier countries to actually employ remote working. I think 50% of the workers actually do have some form of remote working, like for example, working one day at home, or all the way up to just 100% working from home. So this has been a trend, or it's not new in the US. So in terms of right sizing, which has been happening all along in terms of your larger institutions like your FIs, financial institutions, I think this remote working is less worrying if you look at the US market versus the Singapore market. So I think all in, we still feel Manulife to be very defensive in a way, and the yields are actually also really quite attractive, around 8%. Yeah, so this would be a good time, or rather to buy the dip. Yeah. So that's all for me, and I think that's all for today. So thank you everyone for all your questions. We hope to see you again next week. Have a good day.